The asset management industry, as most of you know, is huge, in keeping with the vast size of the American financial markets. The OFR report puts its size at $53 trillion in assets under management. It's also a highly varied industry. There are mutual funds and other registered investment companies, hedge funds, separate accounts that are managed by various types of investment advisors, private equity funds, venture capital funds, and other types of funds. Further, different managers focus on different financial markets and/or use different approaches to investments. They also differ considerably in key risk factors, such as the use of debt to leverage potential profits and losses. The key difference between asset managers as a type and financial intermediaries such as banks is that asset managers primarily act as agents for others, while financial intermediaries put their own money at risk. So a bank, for example, borrows from depositors and from the capital markets, lends out money or buys securities, and has the profits or losses that come from those activities. Now, this differentiation between acting as an agent and acting as a principal is not completely black and white, since financial intermediaries can sometimes act as agents, and asset managers may participate to some extent as principals. Nonetheless, this agency-principal distinction is a key one. So our event today is structured around two panels. The first will be moderated by me and will provide an overview of the key analytical issues and facts related to asset managers and financial stability. The second panel will build on this by bringing a series of perspectives on whether and to what extent systemic risk exists in the asset management industry and its activities, and how it ought to best be handled by policymakers. My colleague, Martin Bailey, who is head of our Initiative on Business and Public Policy, will be moderating that panel. So let me now introduce the first panel. We'll start with Richard Berner, Director of the Office of Financial Research. His full bio is available to you. We have a pile outside if you didn't get one. But let me give you a few highlights. Dick is the first head of the OFR, which is only a year or two old, depending on how you count it. Prior to that, he was co-head of global economics at Morgan Stanley for many years. Going farther back, he worked for the Federal Reserve Board for 7 years, in addition to holding other private sector positions. Our second panelist on the first panel is Brian Reed, Chief Economist of the Investment Company Institute. He too worked at the Federal Reserve Board before, in his case, coming to the Investment Company Institute in 1996. His talk will focus on registered investment companies. Craig Lewis, Chief Economist of the Securities and Exchange Commission, had to cancel at the last moment, unfortunately. The panel will open with about 20 minutes of remarks from Dick, followed by remarks from Brian. I will then ask them both to come up here for a discussion among the three of us, followed by a question and answer period with the audience. With that, let's please welcome Dick Berner.
Thank you, Doug, for that kind introduction. It's really a pleasure to be here. I'm delighted to participate in this program, and I thank Doug and the other organizers for sponsoring it, and Martin. I am happy to have the opportunity also to be here with Brian, Paul, and others to explore the question using facts and analysis of whether certain asset management activities might create vulnerabilities in the financial system. In other words, could any such vulnerabilities coupled with a financial shock pose threats to financial stability? Could they transmit or amplify the impact of such shocks? Yeah, let me do that. There we go. From the beginning. That's a good place to start. Okay. Now, I framed the question in the way that I did because it reflects our mandate in understanding the research we did on asset management and financial stability. The mandate, as you see here, has a couple of parts to it. First, the Financial Stability Oversight Council, or Council, asked the OFR to analyze activities and firms in the asset management industry to understand whether or not they might pose threats to financial stability. The Council will assess specific threats and determine if any remedies are needed to mitigate those threats. Specifically, the Council is solely responsible for the process of designating firms for prudential supervision by the Federal Reserve. The OFR supports the Council's work with analysis and data. I want to emphasize that no decisions have been made regarding whether there are threats or whether any remedies for them should be used. So let's start by talking about what we found in our work. The asset management industry, as Doug mentioned, by our estimates, manages about $53 trillion on behalf of global clients, about half of which are for U.S. domiciled clients. As Doug also mentioned, asset management is clearly different from commercial banking and from insurance. Asset management is primarily an agency business, not a principal business. In fact, let me just take a moment to amplify on that point. Asset managers, also known as investment managers, are hired by clients to invest assets on their behalf. In this role, asset managers act as fiduciaries. Asset managers invest within the guidelines specified by their clients for a given mandate. This may include more or less risk-taking. However, the investment results, whether positive or negative, belong to the client. Importantly, the assets under management are owned by the clients. They are generally held by third-party custodians selected by and under contractual obligation to these clients. Typically, asset managers do not have physical control or direct access to clients' assets. Consequently, asset managers have small balance sheets relative to those of other financial services firms. Now, I read that because that actually is the description in a report put out by an asset manager. But it's one with which we completely agree. What we also found is the industry is diverse. The business mixes and business models in the asset management industry, again, as Doug mentioned, vary significantly. So we, in our work, deliberately chose activities rather than firms as the basic analytical building block. Now, it's important to recognize that in this work, we obviously need data to animate and to answer some of the questions that we want to ask. The data, however, are not as easy to come by as one might think. There are significant data gaps, particularly in what are called separate accounts. Doug referred to those in securities lending and in repo transactions. What you see is a slide that's reproduced here from our report. I know this is a little hard to read on the screen, but what it attempts to do is to indicate the sources of investable assets, the kinds of investment managers who are there, the kinds of funds they manage, and it indirectly gets at their activities, which we're going to talk about. What the chart illustrates, I think in broad terms, is that the business mix is quite diverse. Estimates suggest that some firms consist primarily of funds registered under the Investment Company Act of 1940. Those are mutual funds, otherwise known as the 40 Act. Others are a mix of these and so-called separate accounts. Some manage a broad array of asset classes. Others focus on equities or fixed income exclusively. Ancillary businesses are important and have important client synergies in asset management businesses. For example, some use and sell pricing models, securities lending, and other types of businesses. The business models for each of these businesses is also diverse. Some funds may rely on short-term funding, although 40 Act firms are structured to have high levels of liquidity. Some firms use derivatives, others none. Some firms or funds engaged significantly in securities lending, others little. Some firms manage risk on a fund-by-fund basis, others centrally within the firm. The point of all this is that this is a very diverse business which has many models and many mixes. That's also emphasized on this slide, which is also taken from the report. Again, it's hard to see, but if you go to the report, you can see it in detail there. This shows the diversity of business mix among asset managers. I'd make 3 points. Some firms consist largely of mutual funds, and others include separately managed accounts. A few of them, in fact, are predominantly involved in managing separately managed accounts. This diversity partly explains why, when you think about the narrative that we've seen from the industry, it's quite a bit different from our description, because our description was designed to encompass the entire industry, not a particular part of it, but also to recognize the diversity in the industry. Now, this slide does not show the diversity of business models. Our outreach to 10 asset managers, however, confirmed that each asset manager's approach to the business model varies, in some cases to a wide extent. So this is why we chose activities as the basic building block for analysis. First, that approach facilitates analysis of any sources of threats to financial stability, not just their symptoms. Second, it comprehends both asset managers as well as their counterparties. After all, there are two sides to every financial transaction, and of the interconnectedness among them. For example, in securities lending, you also have securities borrowers. Third, it enables the aggregation from activities into firms. And last, we see that data, there's a problem. Data are less widely available for activities and are in many cases not available or adequate for analysis. So this approach that we took has many advantages, but obviously when we think about the gaps in data, that's something that we need to address. And those data gaps are significant. What you see in this table, also taken from the report, is that when we look at companies that are private, for example, not public companies, that is, they're not publicly traded, so the data currently available are more limited than they are for other firms. Likewise, for separate accounts, it's hard to come by reliable estimates of separate accounts. Third, for securities lending, there are aggregate data on securities lending, but those data need improvement. In fact, there are work streams going on around the globe just to improve and focus on those data. Similarly, for data involving repurchase transactions or repurchase agreements, otherwise known as repo, those are surprisingly somewhat limited as well. We in the OFR are making attempts to collaborate with our council member brethren to fill those gaps, and that work is underway. Now, we examined several publicly available data sources that were filed with the regulators and also from third parties. And we took a look at 3 in particular that are publicly filed that I wanted to share with you, because I think it's important to recognize that while there are a lot of filings, as far as the analysis that we're doing, these data were not completely adequate for the work at hand. Form NQ, for example, filed with the SEC. It's a quarterly report of holdings of mutual funds, ETFs, closed-end funds, and other registered investment companies. Those data include significant fund-level detail, such as listings of all security holdings. However, they don't include any information on separate accounts. Form NCSR, another report filed with the SEC. These are annual and semi-annual reports for mutual funds, ETFs, money market funds, and other registered investment companies, similar to a Form 10K or 10Q, but for the individual fund. Again, this form and these reports do not include any information on separate accounts. The third form is called ADV. This is an annual submission of basic firm profile information for all domestic registered asset managers. It does include information on separate accounts, but the data in this form and for separate accounts are of questionable validity because of double counting for sub-advised funds and cross-investing across registered investment advisors. So the double counting makes it really hard to figure out where the separate accounts really are and where the other accounts are as well. Now, we consulted several third-party data sources, those from DTCC, or the Depository Trust and Clearing Corporation, for derivative transaction information. We consulted Morningstar. The data from Morningstar are very similar to and derived from Form NQ. That's an aggregation of publicly available fund level data. And we consulted Pensions and Investments, which is a magazine that publishes survey-based data. So responses to their surveys indicate the size of the industry and other data. And we use those data in conjunction with the others to form the basis for our estimates for industry-level activity. There's a last form that's filed with the SEC, Form PF. Form PF is a form related to private funds, as its name suggests, and that outlines the risk profile of private fund activities in parallel separate accounts, and it's updated quarterly for large firms. The filers include hedge funds and private equity funds, as well as traditional asset managers with private funds. It includes detail on aggregate measures of fund risk. This is a new form. It's just begun to be analyzed, and we'll talk more about the data on that form in a little bit. But we did not consult those data or use those data in this report. So more on what we found. We found that certain industry activities may create vulnerabilities, among them risk-taking in separate accounts and the reinvestment of cash collateral in securities lending transactions. Some specific factors that may make industry activities vulnerable to shocks are listed here, among them reaching for yield and herding behaviors, redemption risk in collective investment vehicles, leverage, and potentially firms as sources of risk. Now, it's important to note that all firms are registered and regulated, but the regulations vary widely, as I indicate here. Let me focus on some of the vulnerabilities. When we think about reaching for yield and herding behaviors, in today's low rate, low volatility world, duration and fixed income portfolio allocations are still quite high. Thus, the vulnerability to a sharp rise in interest rates and or volatility is similarly high. Redemption risk in collective investment vehicles. The ability to redeem mutual funds at daily closing prices is obviously a major benefit to investors. However, this redemption option, especially in funds that invest in less liquid fixed income securities, creates a vulnerability that could amplify shocks. Leverage is limited, as I mentioned earlier, in 40 Act funds, but not so in separately managed accounts. The regulatory framework is something that does pertain particularly to 40 Act accounts. It limits leverage. It limits the share of the portfolio that can be lent out in securities lending transactions, but does not apply to separately managed accounts. And we estimate that separate accounts that include about 40% of total assets under management at U.S. firms. One question I think that is important here is, do commingled investment vehicles engage in what's known in the finance and economics profession as liquidity transformation? That means less liquid assets are transformed into, on the other side of the balance sheet, or transformed in some other way into more liquid assets or liabilities, depending on whose side of the trade you're on. The answer is yes, but clearly the extent depends on the market liquidity of the assets under management. In an S&P index fund, there's virtually no liquidity transformation. However, in a high-yield or emerging market bond fund, there's somewhat more. Now, liquidity is obviously not an issue in normal times, and even less so today when ample funding liquidity from global central banks is boosting market liquidity. The issue, of course, is whether liquidity dries up in periods of stress. Gauging and quantifying market liquidity is challenging. At the OFR, we're doing work on it. So I want to emphasize that we don't have definitive answers here. But, as I mentioned earlier, today's exposure to a sudden unanticipated rise in interest rates, given still high duration and convexity risk and high fixed income portfolio allocations, in my view, means that it's worth monitoring, at the very least, these issues. This slide shows liquidity preferences by investors and the trade-off between liquidity and stability of the investment. Securities lending is an example of an activity that bears watching. Lenders mainly include institutional investors who lend portfolio securities to earn income. Direct borrowers include broker-dealers that most often relend the borrowed securities to hedge funds and to others for short selling and other permitted purposes. As you see in this slide, in a securities lending transaction, a security is temporarily transferred from a lender to a borrower in exchange for cash or another kind of collateral. In the U.S., securities lending cash collateral is typically invested in commingled funds. That is, for example, registered money market mutual funds and unregistered short-term funds, and in separate accounts. The cash collateral must be returned to the borrower upon the termination of the loan. Lenders often retain agents to manage the cash collateral. Many broker-dealers act as intermediaries for hedge funds or other borrowers. There's no single regulatory framework for this activity, but numerous regulatory requirements do apply to both lenders and to borrowers. Now, securities lenders generally consider these transactions low-risk sources of income. But under stress, the reinvestment of the cash collateral may create vulnerabilities. If a securities lender fears its reinvested cash collateral will lose value, or that the borrower will be unable to return the securities, the lender may recall the loan securities. Or a borrower may seek to return securities if it believes that its posted collateral is at risk. The unwinding, as it's known, of securities lending transactions contributed to market stress in the financial crisis. In some cases, collateral was invested in illiquid assets, resulting in losses and forced asset sales as firms sought to raise cash. These losses amplified fire sales and runs, contributing to distress in money markets and other short-term funding markets. I mentioned Form PF earlier. Form PF is not, the data from Form PF were not considered in this report because they were not yet ready for analysis. Some of that cleaning up work has been done. We worked very long and hard with the SEC in order to do that. So we now have some preliminary analysis of hedge funds using the data from Form PF. The Form PF data cover roughly 6,000 hedge funds. I want to emphasize that these results are preliminary and based on analysis of quintiles of funds, sometimes including 1,000 in each quintile, some including 100 or so they must be interpreted with caution. So in other words, the ones that include 100 or so firms are obviously from a greatly reduced set of the overall data. We asked 3 questions. First, what's the relationship between a fund's leverage and the fraction of its assets that are hard to value or so-called level 3 assets? The data suggests actually that they are inversely related. Second, are highly levered funds carefully monitoring their risk exposure? The answer, again on a preliminary basis, is that funds with higher leverage were somewhat more likely to calculate value at risk. Now, this is a rough proxy that we used for monitoring risk exposure. Certainly not the only proxy, but one that might prove useful. Last, what's the relationship between leverage and the level of value at risk? The answer, funds that report higher values of value at risk also tend to report lower leverage. Now, the interesting thing here is that while these results are very preliminary, they seem to contradict the idea that hedge funds typically employ risky strategies. Again, I want to emphasize that these conclusions are very tentative. They're based on preliminary analysis of the data, and one should really take them as the starting point for further work. So I want to illustrate those 3 questions in these slides. This shows the quintiles that I referred to and shows the average leverage by each group and shows that inverse relationship between the proportion of hard-to-value assets in the portfolio and leverage by quintile. In this case, Group 1 has 0 average leverage. It's made up of about 2,600, or half the hedge funds in the overall sample. And the second, third, fourth, and fifth groups each have 665 hedge funds. For the category of funds with the highest leverage, the mean ratio of debt to net asset value of about 2.8, the fraction of hard-to-value assets in the portfolio was less than 5%. In contrast, hard-to-value assets represent about 20% or a little more of the assets of funds with no leverage. Again, this is a tentative conclusion, but one that probably bears further investigation. Second question, are highly levered funds carefully monitoring their risk exposure? Again, as a rough way to look at that, we looked at whether or not the fund calculates value at risk. This is not a crystal clear relationship, but it is suggestive of the idea that funds with higher leverage were somewhat more likely to calculate value at risk. That's not surprising, actually, because the funds with higher leverage tend to be ones that were larger. Finally, what's the relationship between leverage and the value or the level of value at risk? We looked at 510 qualifying hedge funds that report a value at risk measure. After dividing them into 5 categories based on reported value at risk, so 87 of these funds reported a value at risk of 0. This illustrates the point that some of these data might need to be looked at more carefully in order to interpret what really was meant by reporting a value at risk of 0. We put those funds in their own category, and the remaining funds are put in quartiles according to the reported value at risk. The data show that on average, funds that report higher values of VAR also tend to report lower leverage. For example, the group with the highest VAR have an average leverage ratio of about 0.8, about half that of the group with the next highest value at risk. We can't put too much weight on this result without alternative measures of portfolio risk to confirm it. So let me summarize. Asset management is primarily an agency business. In our view, we chose activities rather than firms to be the analytical building block of choice. We found, through our work, that certain activities may create vulnerabilities in the financial system. However, significant data gaps still hinder comprehensive analysis. Now, the Council will decide if whether or not the framework and the designation rules should apply to asset managers, if in fact it pursues this work. The Council, not the Office of Financial Research, must judge if and whether remedies under the current designations framework are relevant. And I just close by quoting Council Chair Liu. We should keep an open mind on this work. Facts and analysis should drive any decisions that are made. And this report is aimed at providing those facts and that analysis. Thanks very much.
Just do yours, Mark.
Trying to find the right one here. There we go. All right, excellent. You'd think the light would be really bright up here, but it really isn't. All right, thank you very much, Doug. I really appreciate the opportunity to speak with you today, and also the Brookings Institution for inviting me here. I want to frame my remarks this afternoon around really, I think, a question that the OFR report doesn't explore very deeply, and that is, how, with decades of experience the asset management industry has had with large fluctuations in financial markets and the like, there is really no evidence that asset managers are transmitting risks to the financial system. And I think some of the points that have been discussed so far, I think, bear elucidating, and so I'm going to examine those. So the three, I think, points that I want to focus on are, first of all, that asset managers, as both Dick and Doug have pointed out, are agents and not principals, and I'm going to explore that in a little bit more detail. Secondly, much of my comments are focused on registered funds, that is mutual funds and ETFs, closed-end funds. And these funds are subject to key investor protections, but these key investor protections also create ways in which it separates the risks of the fund from the advisor, and they do so within the context of the law. So the law sort of enshrines this agency relationship that provides a great deal of protection and separation. The third point that I want to look at is really the empirical data that we're really all called upon to examine, and that is to focus on the core hypothesis within the OFR report, and that is that herding runs and fire sales could propagate systemic risks, and look to see why is it the case that the data do not support a sort of conclusion that registered funds are contributing to these sort of systemic risks. So what does it mean to be an agent? An agent is, such as an asset manager, takes the money on behalf of its clients, be it institutions or individuals, and puts them into either a separate account or a commingled account, fund, such as a mutual fund, and invests it on their behalf into the market, so buying stocks, bonds, other types of instruments. And as has been pointed out, really the key distinction here between the agency relationship and the principal relationship is that the investment risk remains with the investors, not the advisor. And this is quite important, and it comes about in a number of different ways that I'm going to explore. Principals, such as banks, for instance, put their own money at risk, and their capital there is there to absorb the losses on their assets to protect the depositors and ultimately the FDIC and the federal government from sort of taking in losses on that balance sheet. But ultimately, those losses do go to the bank itself, and the capital's there to absorb that. So for registered funds, this agency relationship really helps to limit the risks and the conveyance of risk between the funds and the advisor, the funds and other funds within the asset management industry, and in many ways also funds to outside the asset management industry. So what is key here? The advisor does not hold the assets of the funds that it manages. In fact, it's held by an independent separate custodian, and if the fund loses value, those losses do not go to the advisor. It may affect their fee income because the assets shrink, but it is not a loss to the advisor itself. And when I say that the assets belong to the fund or to, in the case of a separate account, the advisor has no right to access, borrow against, pledge, do anything else with those assets because they belong to the funds and to the investors. They're really separate entities. Even creditors cannot go after the assets in the funds, either a creditor of the custodial institution or of the advisor. And if the advisor has financial difficulties, they can't use the assets in the funds to do in any way to shore themselves up. Each fund also, not only is there a wall between the funds and the advisor through this agency relationship, but also there are walls between each individual fund. And this is sometimes sort of forgotten, but losses in one fund obviously cannot sort of affect the performance of another fund. The advisors cannot use assets in one fund to bolster another fund, so they can't borrow against those to support another fund. They can't pledge those securities in one fund to support another fund. There is, again, a wall between each individual fund and isolates that from everything else within the asset management firm. In addition, as been sort of alluded to, the asset managers are often investing in accordance to a mandate either in the fund's prospectus in terms of the client relationship. It may be a large pension fund that wants a small cap investment, and they will do that on their behalf according to that mandate. So all of these features of this agency relationship that are embedded in the federal regulations help to create these various walls and separation. And there are a whole range of federal regulations that are surrounding registered investment companies. And as I said before, registered investment companies in many ways enshrine some of these agency relationships within the law. In addition to that, we have some funds are also overseen by the CFTC. There are self-regulatory organizations such as FINRA also that oversee registered funds. So what are some of the other features of registered funds that actually contribute to these to sort of the reduction of overall risk and as well as protecting investors? And one of the things that's really key here is the lack of leverage. A mutual fund and an ETF cannot create a senior security. It cannot issue a debt instrument. And so therefore, the capital structure of a mutual fund is very simple. It issues shares. Those shares invest in the fund, and the fund invests in assets. While if there is a future obligation on behalf of the fund, it must fully cover these with segregated and unencumbered assets, and those must be liquid assets. Now, the fund may borrow through a bank, but for every dollar of borrowing that it engages in, it has to hold $3 of assets, again, sort of set aside to cover that loan. This simple capital structure then also prevents sort of kind of the pyramiding that you can find in other types of financial intermediaries. There are restrictions on funds' abilities to invest in other investment companies, investment advisors, broker-dealers, and the like. Also, you can't have joint ventures, no off-balance sheet financing. All of these are restricted by registered funds. In addition to these various sort of walls that I've been talking about, there are also requirements upon the fund to help them manage the ability to take in orders from their investors on a daily basis, this daily redeemability, both to buy and sell shares. So their diversification, liquidity, and daily valuation. Diversification tests are mandated by or encouraged by tax law as well as securities law. And while a fund doesn't have to be diversified, virtually all of them are. Portfolio liquidity. No more than 15% of a registered fund's assets can be held in a liquid security. So 85% must be held in a liquid security. Again, going to this liquidity transformation, be it for a stock fund or a bond fund, the underlying assets must be tradable and are tradable in the markets. The daily valuation also is really key here. That is, there's no investor when putting an order in has an advantage over another investor because they're getting the same price at the end of the day. That price is struck when the markets are closed, and no one knows with certainty what that price will be. And so as a result, the diversification, the liquidity, the daily valuation all help for these registered funds to manage the liquidity that they're providing to their investors on a daily basis. So the third sort of element of why is it that we do not see historically for over decades of financial cycles, asset managers contributing to the types of systemic risk that we find in other types of financial intermediaries. And the third element of this is really investor behavior and funds behavior. And this really goes to, I think, a core theory within the OFR report, in which they argue that in the face of large redemptions, you could have funds being forced to sell into the market, and those sales could then be transmitted to other types of entities out there. And I want to explore that for a few minutes, looking again at investor and fund behavior. So I should note that all these data are available in the public domain. The SEC collects them, the ICI collects them, a number of third parties collect them, such as Morningstar, Lipper, Strategic Insight, and the market data are all available as well from a variety of sources, including the stock exchanges and the New York Fed as well. So the core issue that I want to focus on is the extent that we find this herding. And herding is a way of sort of framing the issue to sort of argue that investors are moving in as one in a single direction, causing disruptions in the market, sort of like lemmings, all right, and sort of moving in one way and then another, all right? So what do we see in terms of evidence? Does that even happen? One of the things that we do know, and as you can see on this slide, the solid line here is return on stocks. And when stock returns are strong, we tend to find inflows, which are the green lines. And when stock returns are weaker, we tend to find outflows. That's uncontestable. The question is what is the extent of these flows that we're observing? And so what we've done here, again, these are all publicly available data. We used ours, but you could use any one of the other services out there. We look at the flows on a monthly basis and divide by the previous month's assets and ask what are those outflows for a given fund, what share are they of the assets, and then look at the distribution. And one of the key takeaways here is in 2013, for instance, while we are in net inflow into stock funds this year, we find a fairly wide distribution between sort of a minus 4% and a plus 4% in terms of the outflows. And these are, again, if a fund is around for 12 months, or in this case 10 for 2013, they'll show up in 10 times, depending upon what their flows were in any given month. The center of the mass, though, really kind of hovers right around zero, very closely. And while there are funds that certainly have outflows or inflows even that are more than 4 or 5%, those tend to be fairly small occurrences, but the funds are accommodate these in normal course of business. Now, the question is, what happened in 2008? We had outflows from stock funds, and the question is, do we see a very significant leftward shift in this distribution? The answer is no. That is, during the stock market decline of 2008, which the stock market had its largest annual decline, second largest annual decline since 1825, we saw only a marginal shift to the left in the distribution of outflow, in terms of flows. We still had funds with inflows. We still had some funds with very large inflows. The number of funds that had outflows didn't widen. The tails did not widen in this distribution. And in fact, we even find, and so the outflows are generally occur because of basically a 1 or 2 percentage point shift in this distribution. So thinking about then this herding sort of framing of investors and funds all moving in one direction, we're actually finding evidence of just the opposite. There's quite a diverse range of activity, even in periods where there are outflows or consistent inflows as in aggregate for the industry. So the next question that we ask is, well, what is the extent of these? How large are they? How large are they relative and how volatile are they? And this chart takes data back to 1955. Happy to provide these data to anybody who would like them. And what you can find is that on a month-to-month basis, outflows aggregated for the industry amount to somewhere between a +4 or -4 percentage points of assets. And actually in recent years, in the last quarter century, we found much less volatility, and this range is really much more in the range of a +2 or a -2% of overall fund assets. So then the next way to think about this is then, well, how much are these outflows relative to the size of the capital markets? So again, we looked at the net flows into stock mutual funds as a percentage of the overall size of the US stock market, both the NYSE and NASDAQ, and looked at the capitalization. And again, you can see that the fluctuations in flows, whether they're positive or negative, usually are less than 0.5% of the overall size of the capital market. And in 2008 and 9, when we had the largest outflows, they amounted to about a -0.5% of the size of the capital market. Thinking about the overall trading then that mutual funds were contributing, and again, of the overall capital market. Again, examining this very core issue of herding that the OFR report focuses on and potential for destabilizing runs, we ask, well, what share of the overall trading of the NYSE and mutual funds, stock mutual funds accounted for, on average, about 8% of the overall trading over the last decade. During the financial crisis, that actually fell because the trading volumes jumped in the markets, and the overall share fell closer to about 5%. That is, 95% of the trading in the stock markets was occurring outside of mutual funds. Same thing for bond funds. Let's examine that very quickly here, and we can see the same positive relationship. We do tend to see inflows when returns are up and outflows when returns are down. But again, they're usually somewhere in the order of 1 or 2%, even in the most severe months of outflows in terms of assets. Again, the distribution, the same patterns that we saw for stock funds. They tend to be concentrated around 0, a couple of percentage points above or below. Flows as a percentage of previous month assets. We do find very thin tails. And in 2013, we were in net outflow. 2008, we were as well, but those patterns of distribution look pretty much identical. And then finally, the last point that I'd like to make here is about the overall volume of trading of bond funds. So we've heard about the duration risk and the potential for destabilizing flows. How could this, how may this feed into the market? And what we have found is, we had a fairly sizable run-up in interest rates this summer as the Fed began to signal that it would begin to taper its bond buying program. And what we found was the actual amount of trading, and this is the amount of sales and purchases of mutual funds of fixed income securities as a share of the primary dealers trading, and this is excluding the interdealer market. We found that it actually fell during this period of time, even though there were outflows, because overall trading volumes jumped, and they amounted to about 5% of the trading volume. So the takeaway from all of this is to re-examine and really step back and say, okay, we've experienced decades of financial volatility. The academic literature has not found that asset managers are contributing to the systemic risk. And why is that? And so this is an examination of the facts and the laws and the structure to get a better understanding of that and to think about this going forward as we think about designation and identifying risks in the system. Thank you.
So again, thank you both. For the next 15 minutes or so, what I'd like to do is to have a three-way discussion here, and then we'll give all of you a chance. We have a lot of people crowded here in the room, so we definitely want to give you a little time. First, are there any responses you'd like to make based on Brian's comments, Dick, before we go to other?
You know, I think Brian's comments are pretty much consistent with our comments, namely that asset management is an agency business. We all agree on that. That, you know, we look at activities of asset managers that they might be engaged in that might cause threats to financial stability. Normal trading of registered mutual funds was not really the focus of our activity in the report. Mm-hmm. We focused on, as we mentioned, reinvestment of cash collateral and securities lending, and we focused on risks in separately managed accounts. So that's, you know, since Brian's comments were mostly restricted to registered funds, you know, the data show what the data show. Whether or not that transmits or amplifies risk to financial stability, I might add, you know, may or may not be illustrated in the data that he showed, since what he was showing was flows, mm-hmm. And the flows may tell part of the story. Price action may tell part of the story as well, but that's a different part of the story.
Okay, thank you. One suggestion I would make on your future work in this area, and I'll give you a chance to comment on it because it seems to me a fairly central point. As I was reading through the report, it seemed to me sometimes, at least in terms of explanation, there was a mixing of things that happen because we have markets and people are people, and things that happen because of the existence of asset managers. For instance, the search for yield. I would have thought that the great bulk of the search for yield comes because of the desires of the end investors, not because of the way asset managers operate. I wonder first, do you think that's a useful distinction? If you don't, why not? If you do, what implications might that have?
Well, what I'd say is that there's no question that asset managers are responding to the needs of their clients. Mm-hmm. Asset managers are typically operating under an investment mandate where they are trying to fulfill the needs of their clients, and that typically involves you know, the best possible return for a given amount of risk. So I don't think that the two are inconsistent. Again, what we're talking about is activities mm-hmm. rather than firms, and I think it's the activities that we focused on rather than you know, looking at particular firms.
Well, I guess again, it's a little bit muddy, but it seems to me when you looked at the activities, it wasn't always clear whether you were looking at the incremental risk created by the existence of asset managers or the way they operate, and to what extent you were talking about, in addition to that, risk that simply flowed through.
So as we indicated, Doug, you know, you can have certain activities that might be the sources of risk. Mm-hmm. You might have others that might amplify risks. Mm-hmm. Might have others that could transmit risks. Mm-hmm. All those are important to us as we think about financial stability. And our report was designed to shed light on what the activities of asset managers were and where we saw the risks, you know, might occur. Not to try, at this point, to try to precisely identify. In order to more precisely identify, I'm not sure we ever really can precisely mm-hmm. identify, but in order to do more precise identification, I think one needs better data. And since we lack a lot of the data, as I indicated, particularly for separate accounts, it's not clear to me that any precision is, you know, something that we could really do.
Okay. Let me ask you what may be a slightly unfair question. We'll give you a chance to respond. There's been a pretty negative reaction to the OFR report. You presumably think that's not justified. First of all, am I correct you think that's not justified? And secondly, what do you think is the cause of the misunderstandings? I mean, what do you think the misunderstandings are?
Well, you know, I can't speak for others' behavior. All I can do is say that as far as we're concerned, we stand behind the report. The report was designed to be a piece of research. It shouldn't be confused with something that was aimed at or to be used at in a particular set of remedies, particularly designation. As I made clear, I think that's something that's up to the council. The OFR is, you know, a research and analytical organization. And, you know, so I can't speak for others' behavior or others' reaction to the report. I'm simply saying that as far as we're concerned, the report accurately describes what we see out there in asset management activities and in the industry.
Okay. And Brian, obviously your own organization has responded fairly negatively to the report, but do you think that there are valid lessons that could be taken or points from the report where you believe that it would make sense for industry and the regulators to try to tackle some of the risks that were cataloged?
I think the real challenge is trying to understand what are the risks that are being cataloged, actually. Certainly, the core thesis, again, from my perspective, was the herding, redemption, fire sale thesis. That largely is based on some empirical literature that does use a lot of information from mutual funds and other types of pooled products. But what the real challenge was that while these studies sometimes, and I emphasize sometimes, find that there may be an incremental effect on the prices that would potentially move a price away from its fundamental value. And of course, there's a joint hypothesis there to use a term. First of all, you can identify the fundamental value, and that the action then on the part of the fund or the asset manager has moved it away from there. Is that the real logical leap then is that this is creating a systemic problem. And I think that's really where the burden lies. That while there may be marginal impact on prices, this academic research has not found that this is creating systemic problems for the financial sector as a whole. And I think that logical leap has to really be sort of addressed. And it's alluded to, and so I think that's where our first level of concern was. The second level of concern is that, you know, while a lot of the focus does tend to be honest, on the registered investment side of the business, registered investment funds. That's where the most information is currently. And so as a result, it leads by implication then, that's where potentially the risks lie, just by the fact that it does tend to focus on there. It's sort of the dollar bill underneath the lamppost.
Okay, on herding, and I'll give you a chance a second, Dickman. On herding, one thing that wasn't clear to me, are you going so far as to say that it's not true that markets tend to overreact, that markets tend to go into one sector, for example, the stock market? Or are you saying that it doesn't show up in the registered investment company world? Or what is it intuitively that you're saying about the markets when you make this herding point?
Right. So the herding point is one is left with the impression that trillions of dollars are moving in that direction. I think even in the OFR report they point to money flowing into bond funds, for instance. Now, what we have been pointing out for some time is that the money that's going into bond funds, first of all, is dwarfed by the amount of money that is going into that central banks globally have poured into the bond market, particularly of sovereigns. Secondly, I mean, of 10 to 1. So it's hard to argue, and that was very sort of intentional on the part of central banks globally to drive down interest rates and bond prices up. The second point is that while there may be sort of a shift that may occur sort of during a period of time where sort of in the late 90s, more money was going into tech funds or the tech sector than in prior years, it certainly wasn't the case that investors or funds themselves were sort of moving in one direction as one toward that. And I think the term of herding tends to indicate or suggest that. So I think it's more the characterization of this sort of massively moving trillions of dollars into one area or another that are driving the markets and then could potentially, when pulled out, drive them again. We've seen, as I said, probably the second or third largest run-up of interest rates in a 5-6 month period this last summer, and the outflows from bond funds was very modest and easily accommodated. I mean, while the flows don't tell you what the price impact was, I can look at the daily flows and see that those flows actually occurred after every single run-up in interest rates, not during or before. So I know that they did not cause the interest rates to go up. In fact, it was caused by central banks, Chairman Bernanke discussing future potential monetary policy. And that's very clear from the data.
Dick, anything you want to?
Well, I think there may be a confusion here because the way that we're not arguing that flows into or out of a particular asset class move prices. We're arguing that positioning within an asset class, when positions are being taken, they may be subject to certain risks, and that's the basic point that we're trying to make. So in today's world, where interest rates have been driven down by economic fundamentals, where central banks have been aggressively both using short-term interest rates and purchases of longer-term securities to drive down interest rates, as Brian said, raise prices, lower rates. It's the positioning that is of concern because when that unwinds, those positions may be exposed to both duration risk and volatility risk. And those are risks for the future. We're not arguing at all in this report, nor did we ever conceive of the idea that it's the flows into the funds themselves that drive the prices. In fact, it's the prospect of returns that drive the flows, and it's a sudden reversal in the price action that could create the risk given those positions. So I think that's the fundamental difference here in the way that we would characterize it. I think also there is a misconstruing of the evidence, the analytical evidence, or the academic literature out there. Because while in general the academic literature found that in many cases they couldn't detect on average evidence of herding. The problem with saying on average is that sometimes the averages cover a wide spectrum of results. And so what some of the literature did find is that particularly in small cap stocks, there was evidence of herding, although not necessarily found in the broad stock market. And as I indicated in my comments, what we see when we look at equities, there isn't a lot of liquidity transformation in equity mutual funds. What is perhaps of a little more concern is that there is liquidity transformation that goes on in fixed income funds, particularly those that invest in less liquid securities. Now, the last point I think is also important. When we look at aggregate flows or aggregate positions, we're looking across the spectrum of risk in the financial markets. That may hide particular pockets of risk. And so it's pretty clear that when we're looking for risk, far from looking at risk with a dollar bill under the spotlight, it's our job to look where the light is not shining and to shine some light on where that risk might be that other people may not have anticipated. So we don't focus on registered funds primarily as the source of risk. On the contrary, we focus on the fact that there is a scarcity of data in separate accounts. Those are gaps that one ought to fill if you're going to do more looking into the question. And those are the kinds of things that I think need to be looked at rather than continuing to focus on whether there's herding in stock market mutual funds.
Could I just raise one other point, though, and that is it's unclear and I understand the OFR isn't one that makes the designation of a SIFI designation, but we clearly sort of see that the report goes in the direction of identifying that the investment actions on the part of either funds, the asset managers, or as directed by their clients could be driving investment decisions. That's how markets operate. And so I guess I struggle with trying to understand sort of what the conclusion is to draw away from that. I mean, clearly, if interest rates would rise sharply because there's going to be an anticipated change in Federal Reserve policy, some sectors, some asset classes will respond more dramatically. But that's been the case for decades, and that's not a transmission mechanism in and of itself, even in the activity of investing. And I think that's where the challenge, it's not clear from the report sort of how the activity of investing, which seems to be part of the herding. I mean, you're herding in terms of flows, you're herding in terms of asset classes, and then you're herding in terms of pulling back from that asset class. That's a flow story fundamentally.
Okay, why don't we go to audience questions then? So I just have a few requests. One, please make it an actual question. Ideally, make it a question. And please identify yourself and any affiliation that you have. Thank you. Sir?
I'm Dan Crowley with the law firm K&L Gates. The regulatory agency with the most expertise on regulation of asset managers is the SEC. So it's unfortunate that they're absent from today's debate. But quite frankly, it raises a question in my mind about what role they've had in this whole process. To what extent was the SEC involved in the discussions with OFR? Were their thoughts, suggestions, recommendations accepted by OFR? And do you have any thoughts on why the SEC felt compelled to put the OFR asset manager study out for public comment?
So did we engage with and work with the SEC on this report? Absolutely. We engage frequently with the SEC on all aspects of the report, every single one from beginning to end. The SEC made numerous suggestions. We accepted numerous suggestions from the SEC. We worked hand in glove with the SEC on producing this report. No pun intended, but their fingerprints are on the report as well. So I would say the engagement was frequent, the engagement was strong, and the engagement was complete from start to finish. As far as what the SEC thinks is concerned about why they, put out the comment on the report, I think you have to ask the SEC. We don't typically follow a process that involves asking for comments on the research that we do at the OFR.
Okay. In the back there? Sorry, yeah, that's you.
Thank you. Peter Lindner, IMF. To Dick's point about the activities, isn't there maybe another way of looking at it, and that conforms to, I think, some of your points, namely the use of leverage? Leverage probably has played a big role, particularly in the last crisis. Banking is a highly levered business. Hedge funds are, housing is highly levered in this country. And both banking and housing were at the center of the crisis. Now, when you go to sec lending, it has pure leverage. During the crisis and before, leverage was built up through structures, CMOs that had been around in using time tranching for decades, but then they used credit tranching. Derivatives were used to build synthetic CDOs, etc. When I look at mutual funds, the SEC, if it hasn't changed in the last few years, it doesn't even tell people what the real risk in the fund is. You have to put the 10 biggest positions out there. If you put up, 1/3 of all your assets or whatever in the form of futures, and the futures haven't experienced any change in value, it's not on there. The retail client can't even see what's going on. So what do you think about, looking at it from the more, quote unquote, dangerous activities rather than looking at the whole industry, and one gets into discussions of, these data or those data, flows or not flows, and, focus regulation and observation on these things. I mean, there are other things in the asset management industry that may deserve supervision or more research, but thank you.
How about if I take a crack at that? So you're absolutely right. That's why we focused on activities as the basic building block in order to try to isolate those things which we saw that might contribute the most to threats to financial stability, to create vulnerabilities that might create threats to financial stability. And you mentioned securities lending. That's one activity. Here's where I agree with Brian on one point, however. In funds that are registered under the 40 Act, there are pretty specific disclosure rules, there are pretty specific liquidity rules, there are specific limitations on securities lending in a portfolio, and there are specific limitations on the leverage that they can use, all in the context of 40 Act funds, which is precisely why we tried to shine a spotlight on the areas where there aren't such rules, where there's opacity, where there's a lack of transparency, namely in the separate accounts. And as I mentioned, we estimate that something like 40% of assets under management by U.S. firms, U.S. domiciled firms, on behalf of global clients is in separately managed accounts.
I guess the point that I'd like to make is that the industry has always supported and look for ways to work with the regulators when more data has been wanted. The SEC is looking at the use of derivatives and other types of sort of non-long only instruments, and we will comment and work with them on that. The focus here is the concern is not that regulators find potential areas of concern and want to think about revising regulations or updating them or gathering more information. It's about sort of trying to address that with a very general and in many ways potentially damaging SIFI designation. It's not clear how, again, creating or designating an asset management firm as a SIFI deals with any of these specific issues, and by sort of the example of banks, if it means increasing capital and liquidity for the asset manager, that begins to really break down the walls between the asset manager and the funds that clearly exist both in rules and with the standard of agency. And so, if really the issue is here, are there potential ways in which the SEC could increase oversight, provide additional direction, or whatever? The industry is always willing to participate in that and engage in that conversation.
So it sounds like there is some agreement between Brian and me. It sounds like specific activities might give rise to threats to financial stability. It sounds like you would agree that our report really is not designed to address the question of designation. As I mentioned, the council is solely responsible for the process of designating firms for prudential supervision by the Federal Reserve. It's one thing I stated right at the outset.
I think that we remain concerned that this report could be used for SIFI designation. And I realize that isn't up to the OFR itself, but to use this report for that would be very deeply troubling and should not be used for that. For identifying specific risks, again, these may be ways in which, finding ways in which the Investment Company Act and others need to have further clarification on the activities of funds or the like. But I wouldn't acknowledge that these are necessarily systemic risks, but ways in which perhaps guidance or whatever needs to be updated or clarified or additional information gathered. And I think there is a nuance there that's important.
Mr. Berner, thank you very much for being here today, and I appreciate your comments very much. I'm Paul Stevens of the ICI. I was one of those people. Nice to see you, Paul. One of those people who commented on the report.
And you weren't always nice about it.
I tried to be.
And Paul, let me just say that we welcome your comments. We welcome comments from any quarter on the work that we do.
Thank you very much. You can depend upon us. You have repeated several times that the conclusion of the report is that certain agency activities may create vulnerabilities. And I respect your point of view. But you're not the only one who's been looking at activities lately. We've had 5 regulatory agencies developing the Volcker Rule who have spent years looking at activities of banks. And one of the things they determined is that principal activities of banks could create risks to the bank's safety and soundness and to the banking system and presumably to the financial system. But they expressly exclude agency activities of banks, that is to say, investing activities as an agent, and fiduciary activities. So my question to you is, After all this process, when 5 regulators have determined that agency activities do not create vulnerabilities even for too big to fail banks, why is it when those activities are conducted outside of a bank, they create vulnerabilities for the whole financial system?
You know, Mr. Stevens, I can't really address what your interpretation of the way you just characterized the rule. I was not involved with the rule, and that rule is something that's up to the regulators, not to the Office of Financial Research. But what I would say is that when we look at securities lending activities, for example, and the reinvestment of cash collateral, I don't think that's covered by any rule. As I mentioned, that's not something that's the subject of any comprehensive rule or regulatory purview. And it's something that regulators now on a global basis are taking a look at, both with respect to filling gaps in the data and to finding out more about the behavior of, as I put it, the reinvestment of cash collateral in the event of an unwind of the securities, either because the borrower wants to put the securities back or because the lender asked for the securities to be put back in the case of an unwind. That's just one example of that. And as you're aware, I mentioned another set of activities. As you're aware, there are many other activities that regulators are looking at, for example, the risks in short-term wholesale funding markets that have nothing to do with the rule that you just cited, and which in many cases are agency activities. That does not mean that those activities are without risk. It just means that the risks arise of a different sort.
I just want to clarify one point. That is, actually, the Investment Company Act is quite specific about how to invest the cash collateral. So there are rules around that.
For 40 Act
for
firms.
40 Act firms.
Right.
So, but you said you weren't aware. I just wanted to clarify that there are rules for 40 Act firms.
There are for 40 Act firms, but no, I said there's no comprehensive system of regulation that looks at the activity as a whole. And by the way, it's also important, as I mentioned in my remarks, it's really important not just to look at the lender of the securities, it's also important to look at the borrower of the securities and to look at the activity as a whole. That's really important. And I think that focus on activities and to look at the activity across the financial system, that's what we're really about.
Okay, I tend to neglect the back, so all the way at the back.
Hi, I'm Pete Kyle, professor at the University of Maryland, where I teach a course on asset management. When you look at the last 30 years and the financial crises that have occurred, there are 3 of them that jump out as being triggered by asset managers. The 1987 stock market crash with the portfolio insurers, the 1998 collapse of LTCM, where it was hedge fund managers who played an interesting role as both principals and agents in their hedge funds, and then the role of mutual funds in 2008. What did we learn from the earlier to the stock market crash of 1987 and the 1998 collapse of LTCM about the systemic importance of asset managers?
Pete, it seems to me, and thanks for your question, it seems to me that one of the things that we learned is that in each of those instances, we learned that a focus on activities rather than a focus on, who might be involved and engaged in those activities. There may be many parties engaged in those activities. But a focus on the activity itself, you mentioned portfolio insurance. That was an activity in which many kinds of institutions engaged. But if that was the root of the problem, I'm not saying necessarily that it was, with all due respect, but I'm simply saying that's something that regulators then focused on as a source of the amplification, at the very least, of the dynamics of markets as they unfolded during that period.
I guess the premise that asset managers were key to those 3 financial crises, I guess I would take issue with that. Fundamentally, the 2008 crisis was one of leverage in banking. It started there, it continued to metastasize and continued to increase, and eventually, as one market after another began to collapse, that then spread to other markets, and fundamentally, that was not an asset management issue driven process. That was about leverage. It was about poor quality mortgage-backed securities that were issued and then bundled together and sold off. And again, for the long-term capital management, again, it was particular hedge funds that had borrowed from banks that potentially couldn't then repay to those banks, engaging in leverage there as well. So, again, if there are activities that we want to look at that require further discussion and focus, I think, again, that's perfectly fine. This report does really, to me, seem to go beyond that, though. Maybe that's not the intent. Maybe that's not where it's going now, but from a plain reading of it when it came out, that seemed to be the direction.
Okay, sir?
Chris Faulkner McDonough with Stiff Brothers Investments. Thanks so much for coming today. Maybe I want to pick up on the last two things. Pick up on the last set of charts you discussed from incomplete analysis of Form PF, and in some sense defend leverage, right? Because there's this inverse correlation between leverage and risk assessment. And in my mind, as an investor, one of the most risky things to do is not assess risk. So maybe if you could just spend a little bit more time talking about the types of firms that covered and the lessons learned from that. In particular, I mean, even the great sage of Omaha uses leverage, right? As we found out. What do we learn from that? Maybe elucidate on those charts a little bit more, please.
Sure. Thanks, Chris. First of all, financial activity involves risk-taking and the pricing of risk and the management of risk. And all three of those things are really important. Otherwise, there may be no return. Sometimes they go hand in hand. So I would quite agree that it's not the question of whether or not leverage is being used. It's a question of how it's being used, how it's being managed, how people are aware of it on both sides of the transaction. That's really the key. The purpose of the analysis that we did in Form PF was really to show that a preliminary investigation of the facts in Form PF, and it's a preliminary investigation, actually turns up some what may be some results that are contrary to the usual perception about leverage and hedge funds in particular. So typically people expect that hedge funds employ a lot of leverage and that's associated with certain characteristics of hedge funds. And the purpose of this analysis is to say, look, a preliminary analysis of these data shows that actually the opposite is true. So it's not that risk isn't being taken, it's not that leverage isn't being used, it's just that it doesn't accord with people's priors. And the point there is to shine a light on the fact that if you look at data and you look at analysis, you may find that the results may contradict your preconceived notions of how things work. And all we're saying is be open to the idea that we should look at the data, we should look at the analysis, we should be willing to shine a light on activities as we see them. That's really the point.
Yeah, I do want to say, and maybe it's because I was in the markets for too long, but I was a little puzzled by the amount of time you spent on those slides, in that it seems to me someone who's working with dynamite will be more careful. Someone who's working with nuclear energy will be even more careful, but that doesn't tell us much about whether they're being careful enough for the risks they're taking.
Well, that's a very good point, Doug, and I think that goes to my point, which is that sometimes your stylized preconceived notions just may be out of kilter with the risk. Somebody who's working with dynamite is likely to be careful, particularly if they've had some experience with it.
Yes, that's true.
Somebody who's working with dynamite may not be so careful if they don't understand what they're doing.
No, it's certainly true, and I did find it interesting. So I applaud you for putting that up there. But anyway, did you have anything? All right, sir.
Andrew Skilkane, Gates. Thank you. I wanted to ask you, Director Berner, at the last FSOC meeting, you spoke about completing a heat map tool, which will allow you to basically analyze different types of data gaps, macroeconomic risk, credit risk, funding risk, et cetera. I was wondering if you could talk a little bit more about that and how it relates into your general conclusions and whether that's asset manager-based or activities-based.
So it's a great question. What's very interesting about your question is that it points out that this discussion we had, and this was at the last meeting of the council, which was open to the public, we talked about a heat map that we were putting together, and I mentioned specifically that it focused on some of the kinds of risks that you mentioned, market, macro, contagion risk, and so on. Those are functional, that's a functional analysis of risk. It intentionally does not focus on who's engaged in taking either side of the transaction there. It focuses on the risks themselves. In other words, it tries to focus on the causes of or sources of risk rather than on the symptoms. So it's deliberate in its focus away from institutions and towards the behavior itself or the source of risk itself.
Hi, my name is Monica Dorjoy, and I worked for a long time in the World Bank, advised a bit on in IMF, and now I work with private sector for now a year. I also teach at Georgetown. And my question, I worked on the intervention, and this morning I was writing to Hank Paulson. And here's my question to you. The number one issue we had in 2008, when we were trying to intervene and stop, the collapse, was number one, funds and how you replenish them, or they were not ready, or the governance of the fund did not allow you to enter in the crisis and intervene. One, so the issue is replenishment. And the second is, what the issue we have is, whether it's IMF or World Bank, this is a private comment, is, and I worked on this also with the FSB, on how we intervene if it's a private versus a public. And how, and what's your take when there is a blend, between the two? So I try to explain as plain as I can. Thank you.
Maybe I could just respond to that. When we think about threats to financial stability, I think the point is that we recognize that when we look across the financial system, we see how threats can spread across the financial system. It's clear that if there's a possibility that there are losses, we want to build more resiliency into the financial system in two ways. One is, and this is built into the Council's mandate, one is to make sure that firms have more loss-absorbing capacity if they're going to be subject to losses. Now, in the case of asset managers, just to bring it back to the topic at hand, the firms themselves don't experience the losses, as both of us have said. It's the investors who experience the losses. But the important point there is that doesn't mean that there aren't losses. So that leads us to the second aspect, or one of the other aspects of the way that policymakers in the Council are thinking about, and everywhere, about financial stability, and that is to restore market discipline and to create the right incentives for people to engage in liquidity transformation, maturity transformation, risk-taking, use of leverage, all the things that go on in the financial system, but with an understanding of where the risks lie and what the trade-offs are. So if we create incentives or put in place guardrails to make sure that people understand those risks, that they take action to manage those risks, that's likely to build a stronger and safer financial system. Hope that responds to your question.
I just think one point here is that the way the Investment Advisors Act, the Investment Company Act is structured, these apply to public or private firms. Those guardrails that Dick is referring to that are already there are there for either type of asset manager or fund or the like. And so, if ultimately the discussion here is about sort of ways in which to refine those guardrails or find where there may be vulnerabilities, that's a very different discussion than one about whether or not we should be beginning to designate asset managers as systemically important financial institutions.
Okay. In the back, I think those will probably have to be the last one.
Hi. Rick Delphin with the Systemic Risk Council. I had a quick question for Dick in particular as to whether or not you thought about other products, activities, and operations of asset managers that might pose a systemic risk. For example, the products you talk about are dealing with separate accounts. Clearly, that's one product. But other products might be money market mutual funds or levered ETFs and the impact they have on late-day volatility. And those products are not really discussed in your report. I know money market funds are a separate issue, but that seems like other kinds of products. In addition, there are other activities. You talk about sec lending as an activity that might have a systemic risk in repo. But I wonder about order cancellation and high-frequency trading. Those are activities of asset managers that might have a systemic risk on the amount of liquidity in the system or the market volatility. And finally, operationally, there was Waddell and Reed and the flash crash and the impact that that asset manager had just in putting a wrong order into the system, and that had on the system. So I wondered if you looked at those issues as well, or if you just focused on the particular activities you've talked about.
Rick, thanks for your questions. Good to see you. We miss you. Where we used to see you frequently. So I think the answer to the question is we wanted to focus in this report on the activities that typically asset managers engage in. The things that you're talking about are clearly the subject or are subjects that both the Council and we and other prudential authorities around the world are looking at. It's not that they're unimportant, it's just that we need to define the scope and breadth of what we're doing here. Those are potentially important issues, and work is being done on those issues, but they were not in the scope of this work.
Brian, anything you want to add?
No, I think, some of those very issues that you pointed out, the SEC is already looking at, in terms of market structure reform, and the like, and so they seem to be proceeding at the agency that has the primary regulatory authority here.
Okay, well, let's thank Dick and Brian, and then we'll turn it over. I'll turn it over to Martin Bailey for the second panel.